It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. A challenge to Powell. President Trump readies his list of picks to replace the Fed chair. Reclaiming the throne, Nvidia hits a record high, overtaking Microsoft as the most valuable company in the world. And far from a deal, House and Senate Republicans still at odds on SALT deductions for high-tax states. The move yesterday, you have to go up 4 decimal points to see what the S&P 500 did yesterday. That is the smallest move in either direction since 2017. Thank you to Deutsche Bank for that statistic. Even so, the NASDAQ hit another record high. Nvidia hits a record high. You get gains again this morning, up 1/3% for the NASDAQ, 0.5% for the NASDAQ, rather, 1/3 for the S&P 500. The bond market, perhaps more interesting this morning. It is a clear rally on the front end with that journal report that Trump may announce a pick for Fed chair sooner rather than later. He tells us he's got 34 names on that list. You see 2-year yields come down 1 basis point at the lowest since May 1st. 10-year yields, similar dynamic. They're down about 1 basis point. All of that also sending the dollar much weaker, the weakest versus the euro since 2021. Let's get you some stocks to watch this morning with what's moving in the pre-market is Joe Easton. Hey, Joe.
Hey Danny, so it's all about the chip stocks today and the pre-market movers. We got a trio of chip stocks to bring you. Firstly, Micron beating expectations last night, selling a lot of their chips into the AI space. The earnings much better than expected, and the stock extending its recent gains this morning. We're up 2.6% on that one. But then the real star of the show, Nvidia, of course, as Danny mentioned a moment ago, hit a record high yesterday, set to open at another record high today. The stock up 60% since the lows in April. Now, all of that boost really coming from those big companies, Microsoft, Google, that it sells those chips into. So that stock, Nvidia, higher again, around 1% today. But going the other way, ASML, a Dutch-listed firm, of course, but also US ADRs, hit today by a downgrade at Jefferies, which says it has significant concerns about the impact of US regulations restricting exports to China. And as usual, check out the Before the Bell opening wrap on the terminal for a fantastic wrap-up of all these news and more. Danny.
Joe, thank you so much, and we will see you later in the hour. Also in this hour, we'll speak with Max Kettner of HSBC on this risk-on environment, and Terry Wizman of Macquarie on possible early announcement of a new Fed chair. Now, risk assets remaining resilient despite successive geopolitical shocks. Max Kettner, chief multi-asset strategist at HSBC, writes, "We argued for a risk-on stance over the summer. This hasn't been met with a lot of agreement in the last 2 weeks, but we think the biggest risk to our view is that we're not bullish enough." Joining us now is the bull himself, Max Kettner of HSBC. Max, really great to see you. So what are the upside risks to your outlook at this moment?
Yeah, good morning, Danny. I think actually what we're facing right now is this classic wall of worry. If you had to write a textbook on what wall of worries is, it is right now. We obviously had just geopolitics that markets were facing, still fretting around whether that ceasefire holds or not. We obviously have the 9th of July deadline on tariffs. We then had the 12th of August deadline. Even if that passes, I guess people will still be fretting around perhaps the possibility of some sort of possibility of a failed bond auction in treasuries. Then, of course, the narrative now for the second half, a lot that we've been hearing, particularly from macro guys, from economists as well. Fine, second quarter US growth is okay, but none of that is genuine strength. It's only just front loading. In fact, under the hood, the US consumer will feel the strain, and by the second half, maybe third, maybe fourth quarter, we're going to start to see the reversal of those front-loading effects. So to me, actually, one of the upside catalysts is just climbing this perennial wall of worries. It reminds me a lot about the beginning of 2023, when also people were very, very bearish. Positioning is another catalyst. In fact, when we look at our measures of long-only positioning, long-only investors in particular, are as bearish on high-yield credit as they've been in 2022 and 2023. We look at, you just were talking about new all-time highs in the NASDAQ, and despite that, all of our shorter-term positioning stuff is still sending a buy signal. So there's a lot, I think, to go for, a lot of sort of technical factors, but also very low growth expectations, very low earnings expectations. Look at Q2, the Q2 reporting season. Actually, consensus is saying earnings are going to drop quarter on quarter, despite the second quarter from a top-down perspective being really, really strong. So I do think there's a lot to go for, and I really, really think investors are underestimating heavily how much we could see a melt up and a squeeze into the summer months now.
Is it all fundamental at this point, Max, or is something to these new highs or close to new highs that's been driving us? Because to your point, we were all worrying about a war. We were all worrying about all these things, but the equity market wasn't paying attention to it. So what type of market regime are we in right now?
I think it's actually pretty close to Goldilocks regime, at least when we look at some of our data where, we look at different kinds of regimes. It's very, very close to classic Goldilocks regimes with the yields a bit lower, weaker dollar, carry assets in vogue, high yield credit in vogue. In fact, we're almost maximum overweight high yield credit at this point and still sticking to that. I think in total, when we look at the arguments around, is this purely technical driven? Is this purely flow driven because fundamentals are still really bad? I don't believe that at all. In fact, one of the things that kept us a bit bearish in March and April was, well, if there's ever been an incentive for companies to cut or pull their guidance, it's in the Q1 reporting season. And the reality was that, number one, companies were actually pretty happy to extend their guidance, to keep their guidance. And in fact, when we look at earnings beat rate, we look at earnings surprise factor, so how much on average companies beat, it was significantly above where it was pre-COVID on average. So very, very clearly what we are seeing is the fundamentals, the earnings, the plain vanilla, the numbers are actually looking really, really, really strong. And despite that, I think people are just way too much focusing on the news flow, on the politics, on the geopolitics, on the next sort of element in the wall of worries, instead of just plain vanilla looking at the numbers, which particularly from a bottom-up perspective and particularly in the US, look really, really solid.
So we were all distracted, but really since late May 21st, we've seen equities grind higher. And at the same time, Max, you've seen yields come down. It is back to that classic environment of stock-bond correlation. If that is indeed holding, we are back to lower yields, stocks rally. Doesn't that mean there is a threat that if yields do turn around, the correlation sticks and you could get some significant pressure in this equity market?
Absolutely. I think 100% correct. I don't think we're quite at the point yet where I want to be shorting treasuries, sort of be max short stance on treasuries. Not quite yet. I think that probably comes towards the end of July, beginning of August. In fact, what we could be seeing in the next few weeks is this sort of seasonally driven increase in jobless claims. We've already seen that in some states. In California, we've seen it in Minnesota, where some of the rules have been changed around that. So the next 4 or 5 weeks, we could be seeing a bit of an upside potential on jobless claims, and that, of course, would then mean a bit more downside pressure, perhaps on yields. But in order for yields really to rise so strongly that it puts pressure on credit spreads, on emerging markets, on equities, on valuations across the asset classes, we really need to get to the sort of 4.7% area. So we've got this model, this what we call danger zone model. So this, if you like, Tom Cruise kind of model. Sadly, I'm not looking that good, but that's at least what we call it. So that model tells us right now is a 4.7% where really valuations start to take a hit. We're almost 50 basis points away from that, right? Like a good 45 basis points away from that on the 10-year. So until then, I think it's pretty full on, right? If we trade back to 450, 460, so what? Even if the big beautiful bill passes, even in its current form, and we back up another 20, 30 basis points on the upside on the long end. I think given how much we've rallied in bonds in the last couple of weeks, that actually doesn't pose a threat to equities and to valuations really across the asset classes yet. Needs to be much closer to 5%.
Yeah, and just all the data you're talking about coming up, Max, it does underscore that you can throw quite a lot at this economy before it falters. But you've mentioned some of the trickiness of the summer and specifically the start of July. July 4th, one big beautiful bill. July 9th, reciprocal tariffs come due. July 15th, you get a CPI report. I know that you are bullish right now and the market continues to climb those events in that wall of worry. But does it put a ceiling on just how risk on you can be, given what we're likely to get in the summer months when usually everybody is away from their desk at a beach somewhere?
I don't think it does. Let's look at the last couple of weeks. Let's look at the last week and a half, 2 weeks. Geopolitics. The market was barely down. The S&P was barely down. We had some sort of solution around it, and we've rallied. We've rallied almost 3% now. So very clearly, we have an asymmetry to the upside. Why? Because positioning is still so subdued. It's not only long-only positioning. In fact, when we look at systematic positioning, that still is somewhere between 25th and 30th percentile on our estimates. So very clearly, what we're seeing is, If we don't see any further bad news, that already is enough of a catalyst for us to rally. And number two, I think now in July and August, when we get the Q2 reporting season, let's be honest, what we could be seeing is we're going to focus on the 9th of July, maybe on the CPI report, maybe then on the 12th of August, the US-China deadline. And instead of that, what we should be focusing on is the reporting season. Let's not forget that the dollar just went down 10%, and that is a massive boost for particularly the mega caps. The 7 mega caps, they made 60% of their money last year outside of the US. So the weaker dollar is a massive boon for them. So that really tells us, I think we're focusing on the wrong kind of news flow right now. Whereas in the next 2 weeks, I think there genuinely, again, as I said, I think there is a risk for a melt-up driven by the mega caps, just how much those earnings could be surprising to the upside.
Yeah, don't make this same mistake again. And we're not in the danger zone. Max, thank you so much. The very own Tom Cruise of HSBC, Max Kettner there, joining us this morning. Thank you for your time. All right, let's get you some other top stories trending on the terminal this morning. The Federal Reserve has released plans to relax a key rule that would reduce capital requirements for big banks. It allows the banks to hold more treasuries and act as intermediaries in the $29 trillion market. Bloomberg reported on the potential change last week. Japan's chief trade negotiator says the country cannot accept the U.S.'s 25% tariff on cars. He added that Japan's automakers produce far more cars in the U.S. than they export to America. He spoke to reporters before heading to Washington for the 7th round of trade negotiations. Meanwhile, Shell says it has no intentions of making an offer to take over rival BP, refuting an earlier report that the two energy giants were in active merger talks. The announcement follows speculation after years of poor performance and rising activist pressure at BP. Back in May, Bloomberg reported that Shell was studying the merits of a deal. Coming up, preparing to replace Powell, President Trump has made it clear he will replace the Fed chair, but he could name a successor sooner than expected. We have the details for you next on your brief.
The only thing that's gone up actually is interest rates, because we have a Federal Reserve chairman that is playing politics. Always too late, a little slow, and I'm not happy with him. I believe he's making a mistake by not lowering interest rates, and I think as well as we're doing, we'd do much better.
You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
The Bank of England cut, China cut, everybody's cutting but him. We can't get this guy to do it. And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
He's making a list. President Trump ramping up the pressure on who Fed Chair Powell should be replaced by. The Wall Street Journal reporting that he might announce a replacement by September or October. Joining us now is Bloomberg's Suzanne Lynch. Suzanne, what do we know so far from the various reportings about how this might take place?
Well, as we heard there just yesterday, Donald Trump doubled down on his criticism of Jerome Powell at that press conference following the NATO summit. And we're now hearing and reading reports that maybe over the summer, that Donald Trump may name a successor. Now, obviously, Powell has 11 months left to run, and the idea of naming someone much earlier than would be usual opens up questions, about what kind of maybe influence this pick might have, a kind of a backseat driver kind of situation, if you like. Obviously, Donald Trump is not happy with the job Jerome Powell is doing. He's criticised him on many occasions and has called on him to cut rates, as we know, a lot quicker than he has.
Elsewhere, Suzanne, in Washington, D.C., the one big beautiful bill still making its way through Congress. There seems to be a split idea in how close or far away they are from an agreement. John Thune seemed pretty enthusiastic that they could get it done by the deadline. But then we had Representative Nick LaLota saying that they're far from a deal on the SALT limit. Suzanne, where do the tensions still exist? How far does it actually seem we are?
Well, it is significant that Republicans in the Senate met with the Treasury Secretary, Scott Bessent. That would imply perhaps things are coming to endgame. The Senate hopes to get this on the floor by Friday. That is the new aim. Let's see if that happens. But As you mentioned there, the salt issue seems to be the problem. Again, Bessent met with some of the key lawmakers here from states like New York, New Jersey, California, which have concerns about this. The Senate version of the bill is keeping that $10,000 cap that existed. The House version of the bill had that $40,000. So this seems to be a key sticking point, but Republicans are signalling that they're hopeful that by this weekend there will be something on the floor to vote on.
Well, Bessent has really been urging Congress come up with something to keep the full faith and credit of the United States. He's been talking about extending the debt limit special measures period through July 24th. Suzanne, what difference would that make?
Yeah, I mean, look, there's a lot of uncertainty here in the big picture. Analysts, as we reported in Bloomberg, think that, they'll be able to meet those payment requirements till August. But after that, a lot more uncertainty. So there is a lot of concern about the broader situation here. Not only do we have crunch time with these tax talks, this tax bill decision, we've also got the looming July 9th deadline for tariffs. And we know that discussions are underway between the US and its big trading partners, the EU, Japan, as we just heard earlier. So all these issues, I think, are feeding into investor concern about these issues coming up in the next few months.
Yeah, a lot of deadlines coming due. Suzanne, thank you so much. We'll catch up with you later in the hour. Suzanne Lynch in Brussels. Now, over at the NATO summit, President Trump said the U.S. would hold a meeting with Iran next week. He doubted that a diplomatic agreement on the nuclear program was needed after the damage that the U.S. had inflicted. For more on the latest, Bloomberg opinion columnist Mark Champion joins us now. Mark, how does that color potential talks if it is a president who is cast doubt on the need for diplomacy given the damage?
Yeah, I mean, it's a very good question. The strikes have definitely changed things, but they have not done what the president says, which is to, eliminate the problem. What they have done is to sort of reduce the urgency of getting a deal. If you're not sitting there, saying that this is the Iranians are imminently about to produce a bomb, and if we don't get a deal, within so many days, then we'll bomb them. Then, the urgency to get a deal very quickly just isn't there. So I think what if you listen to what else the administration is saying, that they're now talking about how this could trigger a deal in Gaza, and then from that, a widening of the Abraham Accords to include more countries. They're clearly thinking in terms of getting something broader. And they don't actually need a nuclear deal immediately in order to do that, the deal with Iran. It's the ceasefire that will allow these other things to happen. That's in principle if the Israelis play ball. Having said all that, ultimately, the bombing isn't really worth anything if there isn't a deal that ensures that in the longer term, the Iranians don't just produce a bomb.
Right. And Mark, it takes some time to get a damage assessment of what exactly happened and the damage done. There's been various remarks, and again, it's still very early. How does the outcome of that also impact the talks? If it does seem like Iran can restart their nuclear arsenal sooner, does it put that urgency back into the conversation?
Well, yes. If there's, if it becomes clear that, really not a lot of damage was done, and that the Iranians could very quickly, they've retained the enriched fuel stocks that they already had, and they have enough cascades to enrich that to weapons grade, and to do that quickly. And they still have some facilities that intelligence agencies believe are developing warheads to put on missiles. If all those things are true, that would mean that the bombing actually achieved very little, and the urgency would return. But within all that we're seeing, it does sort of seem unlikely that some significant damage wasn't done. Just as it's unlikely that it's finished the program altogether.
Mark, thank you so much for that. That is Mark Champion of Bloomberg Opinion. Coming up, the battle of the Titans. Blue Origin owner Jeff Bezos could be a key beneficiary of Trump's feud with Musk. We've got what's in your morning papers coming up next. Let's take a look at what's on the front pages this morning. First up on the Wall Street Journal, the feud between President Trump and Elon Musk producing a potential winner, Jeff Bezos. The Blue Origin founder has spoken to President Trump at least twice this month. Blue Origin CEO Dave Limp also met with the president's chief of staff at the White House. Sources say some of the conversations involved appealing for more government contracts. Next up, the Washington Post leading with the White House planning to limit sharing classified intelligence with Congress. It follows leaks of an earlier assessment that undermined President Trump's claims on Iranian nuclear sites. And on the FT, Wall Street financiers are racing to rally behind an anyone but Mamdani candidate for New York City mayor. Within hours of the 33-year-old Democrats' win, hedge fund investors and private equity titans huddled to find the best way to back a centrist challenger. Michael Bloomberg, the majority owner of the parent company of Bloomberg News, endorsed and contributed to Cuomo's campaign. By the way, Dan Loeb on X calling it the hot commie summer. So that's something for you. Coming up, President Trump ramping up pressure on Fed Chair Powell. We'll catch up with Macquarie's Terry Wizman coming up next. Stay with us on your brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. A challenge to Powell. President Trump readies his list of picks to replace the Fed chair. Reclaiming the throne, Nvidia hits a record high, overtaking Microsoft as the most valuable company in the world. And far from a deal, House and Senate Republicans are still at odds on SALT deductions for high tax states. Well, the move yesterday in this equity market, you have to go out 4 decimal points in order to see the move. It was the smallest since 2017. Thank you to Deutsche Bank for that statistic. But we continue the rally today. The S&P 500 less than 1% away from an all-time high. The NASDAQ, it is already there alongside Nvidia. When it comes to this bond market, it is a rally, a noticeable one yesterday after that journal story that the president might announce his Fed pick sooner rather than later. Yields down by a basis point on the front end, while the euro versus the dollar strengthens by 0.5%. Let's look at some of the stocks to watch this morning. Back with us is Joe Easton. Good morning, Joe.
Hey, Danny. So it's all about the chip stocks in the pre-market so far this morning. Firstly, Micron beating expectations after the close of trading yesterday in New York. So that stock gaining around 2.3% at the moment. A lot of it is due to the exposure to AI and the chips that they are selling into that space. So Micron set to open higher today. But the real star of the show, of course, is Nvidia after that record high yesterday. Set to open again at another record high, already up 60% since the April low, overtaking Microsoft as the biggest company, as Danny explained a moment ago. So that one set to open at yet another record. Then finally going the other way, ASML. This one hit by a downgrade over at Jefferies, which warns of significant worries about the restrictions on US chip sales to China. So they cut the stock to hold. They've had a buy on around 5-year basis, but they now come down to hold. All about the chips. I tried to find a stock outside of the chip sector, but I couldn't manage, unfortunately. All about the chips today. ASML edging lower in the pre-market today, Danny.
Joe, that is totally fine. Excellent work, as always, Joe Easton there. Thank you. Now, the Wall Street Journal reporting, as we've been talking about this morning, that President Trump is considering an early announcement to his pick for the Fed chair to succeed Powell. Yields on the front end fell to the lowest since the start of May on that story, as the dollar fell to the weakest versus the euro since September 2021. Joining us now is Terry Wizman, Global FX and Rate Strategist at Macquarie. Terry, great to see you this morning. Thanks for coming in. Danny. How would an early announcement, September, October, whenever it would be, change the dynamic and how the markets react to what we're getting out of the FOMC?
Well, look, the president is clearly trying to interject himself into monetary policy decision making. Is that much of a surprise? No, not really. Through his social media platform, through his other public comments over many years, he has tried to interject himself into policy making at the Fed. I think what's different now, however, is that he actually wants a person or a personage to come in and serve as that shadow Fed chair, that shadow FOMC, maybe so that he doesn't have to be on social media all the time tweeting about the Fed's decision, and he can leave that to someone else who has experience, who might be able to more articulately, if I can use that word, define what the Fed should be doing. Trump is not very good at that. He says that the Fed is not doing a good job, but he doesn't always tell you what exactly should the Fed be doing. Maybe with the appointment of someone, or the designation is a better word, obviously, of someone who could shadow the Fed for the next few months until such time as Chairman Jay Powell's term ends as chair. Trump will actually be doing effectively a better job of what he already wants to do, which is to inform and guide and interject into policy to some extent. Look, is this completely unusual? No. There have been other countries that have something called a shadow board or a shadow monetary policy committee. They have one in the UK. It's a group of academics who are, appoint themselves independently. They're not appointed by the Bank of England. They're not appointed by the Prime Minister, but they do shadow and talk about what the MPC at the Bank of England does. The difference here, however, is that in the U.S., what Trump is trying to do is put an official stamp on this shadowness or this shadow chairman, whereas in other countries, when you have a diversity of opinions in the public space and you have things like groups of people who challenge the central bank, it's not done on an official basis. I think the difference now is that Trump is trying to do this on a semi-official or official basis with this designation of someone.
If you do get that, it's semi-official, but does it actually do anything to influence Powell?
Well, I think it does, in the sense that it provides at least some intellectual articulation or construct around why the Fed needs to do something else. If you read the minutes, if you read the statements effectively, what you're getting is the opinion of the majority. Are there official channels for the minority to say something? Yes, there is. An independent, a regional bank president, for example, can give a speech that is at variance with what the FOMC does. But there isn't a collective body. There isn't a body of opinion that expresses holistically and coherently the view of the minority. Do we need that? Not necessarily, but I think this is what effectively Trump is trying to establish.
If you do get a Fed chair come his replacement next May, that is an outlier. The convention at the Fed is that you listen to the Fed chair, that they really set the tone for policy. But again, it is only convention that sets that. If it is an outlier, could that be tested? Do you think that this is a committee that would be pushing back?
Yeah, that's a great question. I think what you're trying to say is, what if the president appoints someone to be Fed chair, but that person's view is not in line with the majority of the FOMC? I think that's a problem. The Fed has a tradition of trying, at least, to build consensus around its decisions, right? If the chairman wants to do something that's an outlier relative to what a majority or near majority of the FOMC wants to do, they try to converge in the middle and try to at least convey that there's a consensus with regard to the decision. Doesn't always work. There are some dissenters, but I think the idea is to try to generate consensus. If you have someone who's an outlier and who doesn't care for consensus, I think you can have these divisions of opinion at the Fed and within the FOMC come out more into the open, and it'll be seen by the ambiguity, let's say, of the things that they say in the statement, the divergence of opinions in the minutes. You can see that as a result of someone who's an outlier being the chairman.
So should we get this announcement, does it just argue for increased curve steepening? It's certainly been the initial reaction to this.
Absolutely. And I should say that the reason that the yields in the front end of the curve have come down recently is not just because the president has been talking about designating someone to be the next Fed chair. It's also because Jay Powell himself has moved away from the strict neutrality around the policy outlook that he conveyed back in May. He, too, has been a little bit more accommodative, if you will, or acclimating to the idea that the Fed should cut. You see it in his commentary about the prospect that by the time the July and August data roll around, we may be cutting, assuming inflation is not, shockingly high. So I think the move is already happening at the Fed, and I think the data has moved them in that direction. I think what we're seeing here is a president who's simply just too impatient to wait, potentially until September, but also a president who wants to make his mark in a way that is a more official, if you will, than the use of social media and the use of commentary, which we know Trump is not the most articulate person when it comes to trying to offer different opinions. I gotta say,
but it seems like having someone as a punching bag at the Fed is useful for him, though, that he can blame the woes of high debt costs, he can blame the woes of the economy to someone who's at the Fed. If he doesn't have that anymore, it feels like he loses kind of a key thing that he can, a key tool.
Absolutely, which is exactly why the president must be careful here, because if he appoints his own person, his mini-me in effect, to run the Fed, he won't have them as a punching bag anymore if they don't do what he does. And we've seen many examples in the past. I would actually put Jay Powell is an example, right? Someone who was appointed, a Republican who appointed to be the chair, and in the final analysis did not end up doing exactly what a Republican president wanted him to do. Trump runs that risk again if he appoints someone, in March to replace Jay Powell, only to find that that person has an independent streak and has only displayed an affinity to Trump's views until such time as he's appointed and has taken power at the Fed.
Well, Terry, as you noted, the move lower in yields started before this, maybe late May. Yields moved lower, equities went higher. The one thing that feels like it's been since the start of the year is the dollar.
Of course.
War, no war, economy good, economy bad, dollar weak. What stops this trend?
Look, we've been talking about the prospects for a weak dollar even before April 2 and before Liberation Day. There were plenty of things that were happening abroad, let alone in the U.S., that were militating in favor of a weaker dollar. We anticipated the change in government in Germany, for example, and the prospect that we'd see fiscal reform. There was important pro-growth policies potentially coming out of Canada. China was being stimulative. The BOJ in Japan was still on a normalization tack. So there were things militating in favor of a weak dollar, before April. And of course, then you had the shock of Liberation Day that reduced the brand name of the dollar even further, called into question the reserve currency status of the dollar because the U.S. seemed to be edging away from its global responsibilities. And now in the last few weeks, we have other things that are militating in favor of a weaker dollar. Obviously, the lack of integrity in Fed policymaking if Trump has his way, but also things happening in Europe that seem to be militating in favor of a weaker dollar, at least a stronger euro. So I don't think there's anything right now that stands in the way of a weaker dollar. I certainly don't see it on the horizon. If war breaks out again in the Middle East and there's a flight to safety and a flight to quality and some haven seeking on the part of investors, the dollar could strengthen again, as we saw when hostilities broke out. But barring that, there doesn't seem to be anything in the way of a weaker dollar right now.
Dollar's still weaker versus the euro this morning, more than 0.5% at a September 2021 low. Terry, thank you so much for joining. Brilliant as always. Terry Wizman of Macquarie, and you are watching Bloomberg Brief.
The only thing that's gone up actually is interest rates, because we have a Federal Reserve Chairman that is playing politics. Always too late, a little slow, and I'm not happy with him. I believe he's making a mistake by not lowering interest rates, and I think as well as we're doing, we'd do much better.
You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
The Bank of England cut, China cut, everybody's cutting but him. We can't get this guy to do it. And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
President Trump is making his list for a potential new Fed chair. The Journal reporting that it could happen as soon as September or October. Back with us now is Bloomberg's Suzanne Lynch. Suzanne, we were just talking to Terry Wizman of Macquarie about this and the possible market impacts. Does it seem like we will get something of a shadow Fed chair?
Yes, I mean, this idea that Trump may impose his own person, if you like, to try and steer policy or influence policy in some way from the back seat, won't be in power but will be there in the background. I mean, this is a reality that may happen if he goes ahead, as he seems to have confirmed there in that press conference yesterday that he would. He said specifically that 3 or 4 names he's considering. He has made it very clear that he's unhappy with the Fed chair. He wants him to be moving on interest rates. So we do, all the signs are that he is actively considering this and may well do so before the summer's out.
Meanwhile, in Washington, D.C., we're getting very close to the deadline for the One Big Beautiful Bill, just over a week away. How divided does it seem this Congress is on things like the SALT limit?
Yeah, I mean, this SALT limit, the state and local tax provision, is emerging as a key sticking point now as we reach end game on the Senate side. The Senate is hoping to get this bill to the floor to have a vote on Friday, but lawmakers, Republican lawmakers from those high tax states like New York, New Jersey, California, they have been expressing their concern. So let's see if they're able to hammer something out to get this over the line. The Senate version of the bill and the House version differ on this issue. So this is emerging now as a key point as we enter what Trump hopes is the last few days on this. He is wanting to get that bill on his desk to sign by July 4th. So it's a key weekend and a key 48 hours coming up.
It's also key, that timeline, for when we get more trade deals, because, Suzanne, the NEC director Kevin Hassett has said that once the One Beautiful Bill passes, then they'll start to announce some trade deals. This coming from Reuters, that the India and U.S. are still in a deadlock of talks ahead of that deadline. You're there in Brussels. How does it look like even EU-U.S. negotiations are going for this trade deal?
Look, it's a huge issue for Europe. The EU, it's a market of 450 million people, and it's a huge trading partner of the United States. As we're talking here, EU leaders, all 27 prime ministers from the European Union countries, are meeting here in Brussels. They've just come straight from that, and a lot of them have come straight from that NATO summit in The Hague. But the focus now, it has been on defence, is now on trade. We do expect these EU leaders privately to discuss strategy today. The European Commission President, Ursula von der Leyen, who's in charge, essentially, of EU trade policy, she's going to be meeting with leaders, she's going to be briefing with them, and more importantly, trying to listen to member states, to EU countries, about what strategy the EU should take here in negotiating with the US. They are very concerned about possibly, we have these 10% tariffs, but also those tariffs, those sectoral tariffs on aluminium and steel, on autos, and obviously on the pharma sector if those tariffs come. So we're really expecting discussions to intensify here over the next few days ahead of that July 9th deadline. And as I say, it's happening just across the road from me here in Brussels today, a big discussion on this.
Suzanne, we look forward to catching up with you with any announcements coming from that. Bloomberg's Suzanne Lynch, thank you for your time this morning. Now let's turn to tech. Nvidia extending gains after closing at an all-time high. CEO Jensen Huang reassured investors at a shareholder meeting that demand for AI chips remains strong. Joining us now is Bloomberg Tech Europe anchor Tom McKenzie. Tom, it was an Nvidia that was unloved to start the year, and the trend has been higher and higher ever since. What's been the reason behind this latest leg higher for Nvidia?
Yes, since those lows of April, as you say, Danny, the stock is up, a little over 60%, and it's pushing higher pre-market today as well. Jensen Huang talking at that shareholder meeting and re-emphasizing for investors that growth, that demand for his GPUs, his AI accelerators, of course, is still there, saying we are still only in the very early innings when it comes to the build-out of infrastructure around this new computing world that he envisions. So there's that reassurance on the back of solid earnings, on the back of recommitments from the big hyperscalers, the Microsofts of the world, of course, the Amazons of the world, not in any way, in any sense, pulling back in terms of their spend around the data centers. You've got all the push around sovereign AI, of course, the commitments in the UAE, the commitments in the Middle East, and here in Europe as well, to build out those data centers, into which, of course, those GPUs from Nvidia will play a crucial role. So it's that all that coming together to continue to give legs to this stock that back in April, of course, had been in the doldrums. It's up about 15% year to date, but the growth is there. And in terms of the multiples as well, interesting, if you look at it, 31.5 in terms of the multiples on a kind of 12-month earnings prospects. That compares to around 27 for the NASDAQ 100 for a stock, of course, that's expected to grow much quicker than most NASDAQ 100 listed companies. So in terms of valuation, it doesn't look too stretched at all. In terms of the long-only funds as well, this is interesting. Long-only funds have about 74% of them have exposure to Nvidia. That compares to about 91% to Microsoft. So there's still a bit of a catch-up in terms of long-only funds and their exposure in terms of big tech to Nvidia versus some of the other names in that basket. And for some, looking at that piece, that suggests there's more money to put to play. There's further upside for this stock, potentially.
Tom, quickly, it seems like however bullish we are about AI, something in the market surprises us that maybe we weren't bullish enough. Is that the case with Micron and their earnings?
They beat in the third quarter, they beat on earnings, they beat on sales, they beat on profit, they beat on revenue, and the fourth quarter estimates was a beat as well from Micron. This stock is up about 50% year to date, but what they didn't come out and is articulate gangbuster growth going forward. The growth is still going to be there. They emphasize this, executives. The scrutiny with Micron is on the HBM, or the high bandwidth memory chips, to which they have seen huge demand. They have to go and complement the GPUs that go into these data centers. They don't see any slowdown. It's just that what they predicted, what they forecast, wasn't smashing it out of the park like some expected in terms of investors. Morgan Stanley putting out a note and a response saying the biggest inflection in the cycle is now behind us. We see the valuation on Micron as demanding.
Tom, thank you so much. That is Bloomberg Tech Europe anchor Tom McKenzie. Let's turn now to consumer earnings. H&M shares jumping this morning in the European trade. The retailer reported better than expected profit, helped by tighter cost controls. Joining us now with the latest is Bloomberg's Charlie Wells. Charlie, what was the read from H&M?
Yeah, Danny, the read was positive, and the market this morning is really liking what it's hearing. And this seems, at least to some investors, like the sign of a turnaround that H&M has needed for a long time. This is a fast fashion retailer that has struggled to gain traction relative to a lot of its competitors. It is an arch rival of Inditex, that is the parent of Zara, and they've really struggled relative to Zara to try to kind of beat back some of the new competitive pressures that they face in the space. They've had other headwinds as well. One of the issues in that fast fashion space is that margins are so thin, and something that kind of differentiates H&M from Zara is that H&M relies significantly more on suppliers from Asia. So some of those freight costs have gone up. That has eaten into the margins for H&M. I talked about a turnaround, and that is something that management has really been focused on at H&M. They really want to get their margin up to 10%. Now, we're seeing in some of these numbers coming out this morning, and I think this is what the market is liking. We're seeing cost controls, as you mentioned. That is something that could help margin. But another issue here really is revenue, and that is a little bit more challenging if you think about it. They've got to think about demand. They've got to think about that core brand and driving demand, and we're not seeing that quite as strong as we might want. So this could be positive sentiment today, but still that stock has been under pressure over the past few years.
Hey, Charlie, quickly here. We're also going to get Nike earnings, another company that might need to convince the market it can turn things around.
That's exactly right. So there's really going to be a focus today on how they can kind of refresh that product mix. We're getting a little bit of an answer from social media, at least for the sorts of products that might be taking off at Nike. One is the Snowfur, which is a little bit of an unexpected mix, but it's gaining a lot of traction online. Resale value at $500, even though these really are not from Nike on sale yet. So just a glimpse of how important social media it is and how Nike is trying to refresh that mix. This is a mix of a sneaker and a loafer. Let's see if that translates to earnings quite yet.
God, I'm looking at them now. Not for me. Just going to say not for me. That's so weird.
Pass for
You're going to wear them into the office, Charlie? No?
No, not for me.
See, we can't see your feet. We don't know that you're not wearing Snowfurs right now. So we'll leave that to the audience's imagination. Charlie, thank you so much. Charlie Wells, you're watching Bloomberg Brief. Get you set up for your trading day. On deck, an exclusive interview with San Francisco Fed President Mary Daly. That's at 8:30 a.m. Eastern. We'll also get jobless claims, durable good orders. Those also come out at 8:30. And we're going to get more earnings before the bell. Will be Walgreens and Nike after the market close. Let's look at the dollar because this continues to weaken versus the euro. It is at its weakest level since September of 2021. Euro is just above 117. We're talking with Thierry Wizman of Macquarie earlier, saying that the forces are there. It's not just the most recent thing moving it, which is the Journal saying that we might get something of a shadow Fed chair with Trump announcing it sooner, but it is structural forces, more spending coming out of Europe. That was at least the outcome of the NATO meeting. All right, that's it for your brief. Surveillance takes it from here.